Paul, how are things on the ground right now, and what is your advice to global investors who are sort of witnessing the mayhem?
Good morning, and thank you for inviting me again. Well, that's a really good question. I think really the central message that I would have is that in Hong Kong and China, the number of new coronavirus cases is actually dissipating. It's actually falling. So the way in which I view the world at the moment is, in terms of this particular event from a healthcare perspective, is that there is much more concern outside of that epicenter, as you pointed out. So this is, I think, this is important on a couple of levels. Number one, what it means is that the price destruction, the valuation compression that we've seen in Hong Kong and China due to the protest movements, the trade war, and then coronavirus itself, probably means now that the relative risk in the equity space globally is actually outside of that. And that's part of the reason why fairly recently we have upgraded Hong Kong and China to neutral from underweight. That underweight has worked out very well for us. And we have actually recently upgraded China A to overweight. Now, what we did with this in our Asia-Pacific strategy is that we took down our biggest overweight, which was India. We're still overweight, but we were a very large overweight to now a sort of a minor one. And we took down weightings and our rating in Singapore and also Thailand from neutral to underweight. So the real issue is it does the coronavirus issue, through its impact on the energy market, lead to some form of credit shock? Now, the last episode that we saw in late 2015, early 2016, was when high-yield energy in the United States saw a significant credit shock, which affected the entire credit space globally. Now, we've got our preconditions for a similar type of event hitting now. Now, it hasn't occurred. We haven't seen credit spreads rise to the degree that we've seen during that episode. But there is a risk that what we see in this current environment is that through the impact on credit markets, we may see further risk off in equity markets.
Yeah, that we are seeing under our nose, as it were, Paul. But do you expect coordinated central bank action, finance ministers' action? It is a dynamic situation. Where would you call a bottom at all anytime soon?
No, certainly not. I mean, I think what we've seen so far has been a coordinated monetary policy intervention. We've seen the Fed with, a surprise 50 basis point cut, which we had called well ahead of time. The RBA has cut rates. We're seeing easier credit conditions in China. We're going to see those central banks that have got monetary space easing. And for those economies where there is fiscal space, we're going to see fiscal policy intervention as well. As we all know, fiscal policy has more efficacy when it's combined with easy monetary policy. So I suspect that we'll see that to some degree. So that's already started. So this is, we're in a type of risk event where we're getting towards a correlation one. We've seen this show before, whether it be, and I don't want to be alarmist at all, but we've seen it during previous crisis periods, and this is a type of crisis. There's no question about that. It's not a global financial crisis, nothing like it on any sort of scale of what we saw there, or even the Asia crisis, and so on and so forth. But we do have an issue here where we're seeing asset prices across equities, credit, in particular, moving together, which tends to need to play out first. Spreads need to widen first before you see any sort of form of bottom, and I just don't see that being done yet. Now, in our strategy, which is I'm an Asia-Pacific strategist, we had a tactical risk on our tactical asset allocation from last October, which we called into the beginning of 2020. That's now played out. And our strategic asset allocation view had been somewhat more concerned about the cycle, the trade cycle having been negative, about the risks to an aging U.S. economic expansion, and the prospect for credit shocks. And one of the credit shocks that we foretold last November for 2020 was in high-yield energy. Now, that's now starting to potentially play out.
What do you do now? I mean, are you moving it? You said the tactical play is working out in Asia.
It's over.
Is over.
It's already played out.
Okay,
it's already played out.
So
We're
you
now
continue
into
to
the
sell out,
strategic
go into
view,
dollars?
which is one focused on the cycle.
So what do? You stay on in cash, stay in dollars?
Right. So that's a very good question. So we're seeing very interesting moves in currencies. The Japanese yen is extremely strong. The US dollar is weak generically, except against those currencies which are seeing unwinding and carry trades, like in the Indian rupee, I should say, in the Indonesian rupiah, in particular in the Asia Pacific region. So what we're seeing is that some of the markets that had a premium valuation, like the US, are coming back to earth a little bit now, because growth expectations, which drove those higher valuations, need to be moderated. That is a potential risk in the context of India. We're still overweight India because we see India as being still outside of the ongoing stress that the world economy is facing through the trade war. And its dependence on domestic demand as opposed to the international economy is, if you like, an insulating factor. Yes. Having said that, the connection between India and the rest of the world is not through the trade account. It's actually through the capital account. And that's where we get these carry trade type unwinds, which are affecting the ability for the RBI to be able to respond. Now, the constraint on the RBI has been higher inflation. To be fair, largely due to agricultural price inflation. But reading the RBI minutes from the most recent announcement is that their view prior to this oil shock is that those higher core inflation numbers would persist for at least another 2 quarters. Now, I suspect that's probably less now with falling oil prices. But at this very point in time, there's not as much space. They may well still cut rates, but there's not as much space as they would probably like going into this at this particular point in time, which is part of the reason why I've curbed my enthusiasm on India. Still overweight, but not as much as I was before.
Sure. In your note, you do talk about the risks in India with respect to the financial setup, more importantly, the rising NPLs in the non-banking financial space, etc. We've seen a lot happen here with the whole Yes Bank episode blowing out, a lot of these other banks like IndusInd Bank under pressure as well. Do you see another leg of a down cycle start in the Indian financial space because of the recent issues we've had to deal with?
It is a risk. I mean, I think the way in which this has been dealt with, it's been quite systematic. So, we obviously had the problems in the public sector banks initially a couple of years ago. We had the capital injections there. We then had sort of the RBI risk assessment done on the private sector banks, and that was dealt with. So we saw the recognition of bad debts. We saw the expensing of bad debts. And in fact, we've been seeing among the big private sector banks asset quality improvement. Okay, so Yes Bank doesn't fall into that category. But when we're talking about the major banks, private sector banks, we've actually been seeing improvement there. Now, to your point on the non-bank financial corporations, this has been an area of concern, and this has been dealt with in a twofold manner. Number one has been generically easy monetary policy, i.e. easing credit conditions, and number two has been through macroprudential policy. Now, that macroprudential policy, such as increasing reserve requirements for the NBFCs, has been a factor to try to funnel new lending growth into the private sector banks. Until that sector has dealt with its problems. Now, in normal circumstances, I would say that would be benign. The growth rate in India would be sufficiently strong in order to work through that. But in the current context of a type of global credit shock, then in some sense, one has to recognize that is a potential risk.